Hey everybody, welcome to your weekend review for the week of Monday, January 2nd, 2023. And oh, what a New Year's it was. Welcome to 2023. We were off on Monday. Bond market was closed, so on Tuesday, everything got back to action. European bond markets rallied Monday, and again in the overnight session, reports are showing the European inflation is moderating. This resulted in euro gains. Treasuries weren't in the office to follow along yesterday, but they did open stronger today. UMBS were up 42 basis points early, and the 10-year was down 9. Investors are still reeling from a spell of wonky predictions. They're expecting a volatile year in trading. Fed policy will dictate how stocks and bonds perform. Some traders are already seeking out opportunities resulting from risk assets getting sold off. Recession concerns are continuing to linger as investors ponder whether Fed tightening will push the U.S. into a hard or soft landing. Spoiler alert, it's going to be a hard landing. All eyes are on the jobs report this week as softening in the labor market remains the Fed's focus. Given that Jerome Powell's focus has been the surprisingly strong jobs report, I could see a situation where bad news is good news, as in a weak report could trigger a rally in stocks and bonds, as it would increase the chances that the Fed will pivot to a tighter monetary policy to a more neutral one. Jerome Powell discussed three basic inputs of inflation. First, there are supply chain issues which manifested themselves early on in the pandemic. Second, there is housing, which had the biggest impact since the beginning of 2022. Finally, there is services excluding housing, which basically means service sector wage growth. The supply chain issues have largely been fixed. Housing will probably fade by summer. And final component, services excluding housing, is the focus of the Fed, which means that any negative news in the labor market will be perceived as positive for the markets. That big chunk there comes from Brett Niatre of the Daily Tear Sheet, who is looking for a job. So if you need a capital markets person, he'd be a good person to do it. Manufacturing exhibited the fastest decline since May of 2020, according to S&P Global Purchasing Managers Index. Sinking demand for inputs and greater availability of materials at suppliers led to a further easing of inflationary pressures, which is good. In fact, the rate of input price inflation fell below the series trend. Selling price hikes also eased, albeit still rising steeply. We also got a recession warning from IMF head Kristalina Georgiev, who expects 1/3 of the world's economy to go into recession. Oil is currently at about $80 a barrel, which is low because of low China demand. That will change if and when they reopen. One major source of trade flows was a hefty slate of new corporate bond inflows. Normally, a headwind like this pushes rates higher. The same is true for a large block trade that hit around 10:30 a.m. Eastern Time. While both of these headwinds exerted some expected forces, bonds nonetheless scratched out some moderate gains, ending the day up 28 basis points on the UMBS and down 8 on the Treasury. So we went back down into that narrowing range, which is bordered by the 100-day moving average on the top, and that is the 50-day moving average on the bottom. So it's a very narrow range that we're bouncing between. It looks like we touched both of them today. But bigger and more important than even that is about setting your goals. It's a new year, so if you're one of the people who uses the new year to set your plans, get started with your goals. Get started with your goals on that, because next week we're going to have a special series of posts starting at our sponsor at WellThatMakesSense.com with the best framework I have ever seen for being able to set up a series of meetings and plans and goals and check-ins and milestones in order to achieve your goals in 2023.